I'm Peter Towers, Managing Director of Towers Business Development. Welcome to this update from improving your business relative to matters affecting SMEs. Early stage innovation company status is attractive to both the company and to investors. The government was aware that people who would develop new technology had great difficulty in the marketplace trying to raise capital, even though some of these inventions turned out to be very good indeed and went on to earn considerable sums of money. In an attempt to help investors make up their minds, the government introduced certain carrots into the amendments which were made to the Tax Act to facilitate the formation of companies known as early stage innovation companies. In the first instance, the company has to be young. That doesn't mean the directors and leadership team members have to be young, but the company has to be young. It has to be under 3 years of age, although there are possibilities that a company up to 6 years of age could qualify. The company needs to have income in the last 12 months of less than $200,000, not including a grant from the Accelerating Commercialisation Grant, and expenditure of less than $1 million in the last 12 months. The company then needs to pass one of two tests. The first test is known as the Gateway Test, and it asks a series of questions, and the company either is able to answer that yes, they have done that, undertaken research and development, already qualified for the Accelerating Commercialisation Grant, being admitted to an accelerator program, and they earn points for each of those answers, and they must accumulate a total of 100 points. And if so, they qualify as a early stage innovation company. But if they don't qualify with the 100 points under the Gateway Test, they can then move on to the Principles Test. And this test asks 5 key questions that the company has to supply written answers to. And that's the process. At the end of this, the company is either declared to be an early stage innovation company or it hasn't. The attraction for the investors, the big carrots that the government has offered, are that the company is able then to be able to advise the tax office that the investors have made the investments, and the investors then receive 20% tax rebate on the value of their investment in the company, up to a maximum of $200,000 for a sophisticated investor and $10,000 for a retail investor. And if the shareholder has continued to own the shares for longer than 12 months and less than 10 years, that shareholder does not have to pay capital gains tax when those shares are sold. If you would like more information, why not visit our website, www.towersbusiness.com.au, or you can contact me, peter@towersbusiness.com.au, and I'll be happy to have a discussion with you relative to the role that Towers Business Development could play in assisting your company to be able to utilise its resources to raise capital as an early stage innovation company, or for that matter, as a crowdsourced funding equity raising company, or utilising Section 708 of the Corporations Act. Stay safe. Have a great day. Goodbye.